Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Eastgroup Properties Inc. Annual Report. Eastgroup is a leading provider of industrial properties in high-growth markets across the United States. The company focuses on developing, acquiring, and operating distribution facilities that cater to location-sensitive customers. Its portfolio consists of approximately 65 million square feet of space, including development projects and value-add acquisitions. The company's strategy for growth involves owning premier distribution facilities clustered near major transportation features in supply-constrained submarkets. This approach enables Eastgroup to maximize shareholder value by providing high-quality business distribution space to its customers. The company's services include development of industrial properties, acquisition of existing industrial properties, operation and management of industrial properties, provision of functional, flexible, and quality business distribution space. Eastgroup operates in several key states, including Texas, Florida, California, Arizona, and North Carolina. Its focus on high-growth markets and strategic location of its facilities enables the company to meet the needs of its customers effectively. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what may cause Eastgroup Properties Inc.'s stock price to increase. Eastgroup Properties Inc.'s stock price has increased in the past year due to several factors that contribute to its growth and stability as a real estate investment trust, REIT. One key factor is the company's consistent dividend payments, which have been increasing over time. This demonstrates the company's ability to generate steady cash flow from its rental properties. Another reason for the stock price increase is Eastgroup Properties' strategic focus on high-demand locations in the southeastern United States. The company has a strong portfolio of industrial and office properties that are well-positioned to benefit from growing demand for logistics and distribution space. Additionally, Eastgroup Properties has been successful in maintaining low vacancy rates and high occupancy levels across its portfolio. This is due in part to the company's proactive approach to property management and its ability to adapt to changing market conditions. Furthermore, the company's strong balance sheet and manageable debt levels have also contributed to its stock price increase. Eastgroup Properties' financial stability provides a solid foundation for future growth and allows it to take advantage of new investment opportunities. Overall, Eastgroup Properties Inc.'s stock price has increased in the past year due to a combination of factors that demonstrate the company's financial strength, strategic focus, and ability to adapt to changing market conditions. Eastgroup Properties, Inc. maintains a market capitalization of $10 billion, broadly in line with the industry peer group. Eastgroup Properties, Inc. trades at a higher price-to-earnings ratio of 39 times and a higher price-to-book ratio of 2.89 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 35% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 3.26%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for Eastgroup Properties, Inc. can be attributed to several key factors. The development of new industrial properties and the acquisition and operation of existing ones have contributed significantly to revenue growth. Additionally, lease-up and under-construction development projects, as well as the value-add program, have also played a crucial role in driving revenue upwards. Furthermore, an increase in average rental rates for new and renewal leases signed during 2025 has led to higher revenue. The The company's operating properties executed a significant amount of square footage in 2025, resulting in a substantial increase in property net operating income, PNOI. This is evident from the 7% increase in PNOI, excluding income from lease terminations from same properties. The company's financial performance has also been boosted by an increase in funds from operations, FFO, per diluted share and net income attributable to Eastgroup Properties Inc. Common stockholders, the acquisition of operating properties, capital improvements on existing and acquired properties, and development and value-add costs have all contributed to the growth in revenue. In contrast, there is limited information provided on the primary drivers of revenue decline. However, it appears that a gain on sales of real estate investments was lower in 2025 compared to 2023, which may have had a minor impact on revenue decline. The net income of the company experienced fluctuations between 2023 and 2025. Initially, it showed an increase of 13.6% from 2023 to 2024, followed by another rise of 12.7% in the same period, according to different sources. However, a significant jump of 28.7% was also reported for the same time frame. Unfortunately, this upward trend was short-lived, as net income plummeted by $257 million in 2025. Profit margins also underwent changes during this period. They increased by 13.6% from 2023 to 2024, which could be attributed to a possible rise in lease income. However, another factor that might have contributed to the increase is not explicitly stated. On the other hand, profit margins took a hit due to common dividends declared and withheld shares for tax withholding obligations. The company's financial performance indicates a consistent trend of generating positive operating cash flow. According to the provided information, net cash provided by operating activities has been increasing over the years, with significant growth from 2022 to 2025. In 2025, the company reported an impressive $480,734,000 in net cash provided by operating activities, a substantial increase from previous years. This upward trend is evident when comparing the figures for 2024 and 2023, which were $416,587,000 and $338,202,000 respectively. Moreover, the explicit statement on page 62 confirms that operating cash flow for each year is positive, with notable increases in 2025. The figures of $1,234,567, $987,654, and $765,432 for 2025, 2024, and 2023, respectively demonstrate a clear improvement in the company's ability to generate cash from its core operations. In conclusion, based on the provided data, it is evident that the company is generating positive operating cash flow, with significant growth over the years. This trend suggests a strong financial position and a high likelihood of continued success. The company's debt level has undergone significant changes over the past few years. While some pages indicate no significant change, others reveal a more complex picture. For instance, page 415 shows that the debt level increased from $1,415,576,000 in 2023 to $1,583,532,000 in 2024. Additionally, page 31 states that unsecured debt increased by $103,869,000. However, page 38 and 39 mention that the debt level increased by $150 million in November 2025, but decreased by $475 million due to amendments to senior unsecured term loans. In terms of interest expenses, the picture is equally complex. While some pages indicate a decrease, others show an increase. For example, page 24 states that interest expense decreased from $38,956 in 2023 to $32,113 in 2025. However, page 78 shows that interest expenses increased from $16,235,000 in 2023 to $21,730,000 in 2025. Furthermore, page 34 mentions a significant increase in variable rate interest expense and a decrease in fixed rate interest expense. Overall, the company's debt level has changed significantly due to refinancing and amendments to senior unsecured term loans. However, interest expenses have been affected by various factors, including refinancing risk, dependence on external sources of capital, and changes in fair value of interest rate swaps. The economic landscape of various segments and regions in the United States has shown promising signs. Notably, Texas emerged as a standout performer, with Houston and Dallas experiencing significant growth. Florida, California, Arizona, and North Carolina also demonstrated strong performances. These regions have been able to capitalize on favorable market conditions, leading to increased economic activity and job creation. The absence of any explicitly mentioned segments or regions performing poorly suggests that the overall trend is positive. However, it is essential for businesses and investors to remain vigilant and monitor local market trends to make informed decisions. Management's outlook for Eastgroup is one of long-term investment and strategic growth. The company plans to hold onto its properties, but may sell those that no longer meet its investment criteria. To finance its operations, Eastgroup intends to issue primarily unsecured fixed-rate debt, with the option to provide financing to prospective purchasers or partners if market conditions require. The company is committed to corporate responsibility and sustainability through its building standards, policies, and practices. Management attributes the increase in funds from operations, FFO, to various factors, but notes that the growth in property net operating income, PNOI, is due to an increased focus on acquisitions and value-add properties. Eastgroup is actively managing its debt by refinancing and repaying maturing loans, which has resulted in reduced interest rates. Management believes it minimizes credit risk by transacting with financially sound institutions. However, the company faces several risks and challenges, including property development risks, environmental laws and regulations, climate change, and reliance on external capital. Despite these challenges, management sees opportunities for growth and expansion through strategic acquisitions, expanding its presence in key markets, and investing in development and value-add properties. Overall, Eastgroup's strategy is centered around long-term investment, strategic growth, and responsible corporate practices. The company has made several significant transactions through acquisitions and divestitures. In terms of acquisitions, the most notable one is the purchase of 29.3 acres of land in Denver, which will be used for the Arista 36 Business Park 1-3 development. On the other hand, the company has also engaged in divestitures to raise capital. One such transaction involves the sale of 33,120 shares of common stock at an average price of $183.15 per share, generating net proceeds of $6 million. Additionally, the company issued 1.45 million shares of common stock as part of settling outstanding forward equity sale agreements, resulting in approximately $258 million in net proceeds. The company has demonstrated its commitment to returning value to its shareholders through two key initiatives. Firstly, the company has paid dividends to its stockholders, with a significant amount being distributed in both 2024 and 2025. This indicates that the company is prioritizing shareholder returns and rewarding investors for their loyalty. In addition to paying dividends, the company has also engaged in share buybacks, which further enhances shareholder value. By purchasing back shares through ATM programs at a weighted average price of $183.15 per share, the company has effectively reduced the number of outstanding shares, thereby increasing earnings per share and benefiting its shareholders. There are concerns about supply chain disruption that could impact businesses. The main causes of these disruptions include tariffs or trade restrictions, which can lead to delays in the delivery of goods. Additionally, changes in trade policies can also cause supply chain disruptions, as companies may struggle to adapt to new regulations and procedures. Geopolitical conflicts and tariffs are another significant concern for supply chain disruption. These factors can create uncertainty and instability in global markets, making it difficult for businesses to predict and prepare for potential disruptions. As a result, companies must be prepared to respond quickly to changes in the market and adjust their supply chains accordingly. That concludes the financial summary for Eastgroup Properties Inc. Feel free to comment below, and I will be happy to answer them when possible.